The median bank account balance in America is $8,000, not $80,000. 8 grand. And if you've got more than that just sitting in checking or savings right now, congrats. Statistically, you're ahead of half the country. Which sounds great until you realize what that actually means. Half of American households are working with less than that. Less than 8 grand. That's the cushion. That's the emergency fund. Yeah, not exactly a safety net. And here's where it gets weird. The headlines keep telling us the economy is strong. Stocks have been ripping. Unemployment is low. Inflation has cooled off. So why does it feel like so many people are one surprise bill away from panic? That's the gap we're digging into today. I'm Vanessa, and I've been combing through the Federal Reserve data, consumer surveys, and household finance reports to get a cleaner picture of what the average person is actually dealing with in 2026. And honestly, the numbers are a lot less shiny than the headlines. Let's start with the one that really stings. 67% of Americans are living paycheck to paycheck. 2/3. Let that sit for a second. And no, this is not just a low-income households problem. We're talking about people with solid jobs, six-figure salaries, professional careers, all of it. They get paid, the money disappears into rent or mortgage, car payments, groceries that somehow cost way more than they used to, and then nothing. They're back at zero before the next deposit lands. That's not a budgeting issue in the cute skip the latte sense. That's a structural squeeze. And it gets worse. Nearly 1 in 4 Americans, 24% exactly, have zero emergency savings. Not a little bit, not enough for one tire replacement. Zero. So if the car dies, if they get sick, if the water heater blows up, they're instantly in crisis mode. And 54% of households have no dedicated retirement savings at all. None. They're not ignoring retirement because they're careless. They're ignoring it because surviving this month is already eating the whole paycheck. Now let's talk about inflation, because this is where people get gaslit into thinking they're imagining things. Yes, inflation has come down from the peak. Fine. Technically true. But the damage didn't vanish just because the pace slowed. Prices for goods and services are roughly 25% higher today than they were in 2020. A quarter more expensive on basically everything: groceries, rent, insurance, electricity, the stuff you can't just opt out of. And wages? They did not jump 25%. Most people got maybe 10% if they were lucky, and a lot of people got less. So the math is ugly. Costs surged, income didn't keep up, and the gap between them widened fast. That's why the vibe feels off. In fact, 32% of Americans expect their personal finances to get worse in 2026. That's the most pessimistic reading since 2018. Think about that. On paper, the economy is healthy. In real life, a huge chunk of people are bracing for impact. And that's the split-screen economy in a nutshell. If you own assets, stocks, real estate, retirement accounts, 2025 probably treated you pretty well. Your net worth likely looked better. But if you live on wages, if your income comes from showing up and trading time for money, you're probably feeling more pressure, not less. Here's another number that should make you pause. When Americans were asked what it would take to feel wealthy in 2026, the answer was $2.50 million in net worth. Not comfortable. Wealthy. And when they were asked what they'd need to retire comfortably, the number was $1.26 million. That's the dream number, the I can finally relax number. Now, compare that to what people actually have, and this is where averages start playing tricks on you. You'll hear stats like the average 40-year-old has $91,000 saved for retirement, and that sounds decent. But averages get dragged upward by the people at the top. One person with a couple million saved can make everyone else look way better than they are. The number you want is the median. That's the real middle. Half above, half below. So let's break it down. For people under 25, the median retirement savings is about $2,800. For ages 25 to 34, it jumps to around $15,000. For 35 to 44, the median is about $35,500. So if you're 40 and you've got $40,000 saved, and you're staring at that average number of $91,000 feeling panicked, relax a little. You're not behind the median. You're ahead of it. It gets a bit better with age, though better is doing a lot of work here. Ages 45 to 54 have a median of roughly $61,500. Ages 55 to 64 are around $87,500. And people 65 and older, whether already retired or right on the edge, sit at about $88,500. Now let's be honest, $88,500 is not retirement in any meaningful sense. If you pulled 4% a year from that, you'd get around $3,500 annually. That's about $291 a month. That's not freedom. That's a rounding error. Social Security helps, sure. The average check is around $1,900 a month. Add that to the savings drawdown and you're looking at maybe $2,200 a month total. That's tight. Very tight. And debt? Oh, debt is where this whole thing starts grinding people down. Gen Z, ages 18 to 28, has an average debt load of about $34,000. That includes student loans, car debt, and the fun little reality of starting adult life with bills already attached. Millennials, ages 29 to 44, are carrying around $132,000 on average. A lot of that is mortgages, yes, but also student loans that refuse to shrink, and credit cards used to plug the gap when income falls short. Then you get to Gen X, ages 45 to 60, and they're sitting on the highest average debt of any generation, $158,000. That's brutal. They're in the middle of everything: kids, aging parents, retirement deadlines, all of it. It's the sandwich generation, except the sandwich is on fire. Baby boomers, ages 61 to 79, still carry about $92,000 in average debt. Lower than Gen X, but still a lot for people who are supposed to be winding down, not juggling payments like they're in their peak earning years. And then there's the credit card trap. The average balance for people who carry credit card debt is nearly $7,000. But the stat that really gets me, 46% of credit card holders do not pay their bill in full every month. That means nearly half of people with cards are paying interest, often 20% or more, on everyday spending. That's not convenience. That's an expensive treadmill. If you've got $7,000 on a card at 22% interest, and you're only making minimum payments, you can end up trapped for years. The bank gets paid, and you keep paying for purchases you made ages ago. Cute little finance products? Yeah, not so cute when they're eating your future. And the kicker is, debt doesn't just cost money, it blocks progress. Imagine someone with $132,000 in debt, like the average millennial. Sure, some of that is a mortgage, which is at least tied to an asset. But then maybe there's $30,000 in student loans, a car payment that eats $500 a month, and $8,000 on a credit card at 20%. Now you're looking at minimum payments that can easily run $2,500 a month or more. That's $30,000 a year going out just to stay in place, not to build wealth, not to invest, just to avoid falling behind faster. And that's why emergency savings are missing for so many households. Every spare dollar already has a job before it even arrives. Now zoom out for a second. Americans are only saving about 2.5% of Americans have $25 they want to. Historically, we've been closer to 8% or 9%. And a lot of financial pros would love to see 20% if you're trying to actually build wealth. But 3.5% means people are barely putting anything away, not because they're reckless, because life is expensive enough to swallow the rest. When rent jumps, groceries stay high, car insurance gets weirdly brutal, and childcare or medical costs keep climbing, saving becomes the last thing on the list. And housing is where the pressure becomes impossible to ignore. If you rent, you're probably feeling it hard. Nearly 50% of renters reported difficulty paying monthly rent in 2025. Not, it's annoying. Difficulty, real strain. The median rent in America is around $2,000 a month. If the median household income is about $75,000, that means rent alone can eat 32% of gross income. And the rule of thumb says housing should stay under 30%. So, a ton of renters are already over the line before they've paid for food, gas, insurance, or literally anything else. Homeowners aren't exactly cruising either. If you bought in the last 3 years, there's a good chance your mortgage rate is somewhere between 6% and 8%. That's a massive jump from the 2020 era. A $400,000 mortgage at 7% comes out to about $2,660 a month in principal and interest alone. Add taxes, insurance, maintenance, and suddenly you're staring at $3,500 to $4,000 every month. For a household making $1,000, that can swallow half the take-home pay. And yet, if you already own a home, especially if you bought before 2020, your net worth may look amazing on paper. The house went up, the market went up, your 401k statement looks pretty. You might even feel rich for about 5 seconds. But you can't spend your home equity without doing something drastic. You can't pay bills with unrealized gains. So, someone can have a net worth that's up by $200,000 and still feel broke because their monthly cash flow is getting squeezed to death. That's the split screen economy again. One side is record highs in consumer resilience. The other side is people trying to decide which bill gets paid late. And credit cards are filling that gap in the ugliest way possible. Remember that $7,000 average balance? Let's do the math. At 22% interest, and with minimum payments around $140 a month, that debt can take about 94 months to disappear. That's almost 8 years. And over that time, you'd pay about $6,160 in interest alone. So nearly double what you originally borrowed gets vacuumed up by the card company. That's the business model. They know most people aren't maxing out cards because they're irresponsible. They're using them because life got too expensive, and the paycheck didn't stretch far enough. Then the balance rolls, the interest compounds, and suddenly a takeout order from 6 months ago is still costing you money today. Messy? Yep. Predictable? Also, yep. And this is why the debt picture is so important. It doesn't just drain cash, it blocks every smart move you might want to make next. When you're spending thousands a month just keeping debt alive, you're not building an emergency fund. You're not investing aggressively. You're not saving for a house. You're just trying to keep the floor from collapsing. And underneath all of this is the bigger problem. Wages haven't kept up. Adjusted for inflation, pay has barely moved for most workers over the last couple decades, while the costs that matter most, housing, healthcare, education, childcare, have exploded. Those are not optional expenses. You can't just cancel them the way you cancel a streaming subscription. So even when someone is making more money than their parents did at the same age, they can still be worse off in real terms because their buying power got shredded. That's why so many people feel insane when they hear the economy is doing great. If you're a homeowner who bought before prices and rates took off, or you've got a chunky investment portfolio, sure, the story probably looks good from your seat. But if you're a renter trying to buy for the first time, or you're living mainly on wages with little invested, the economy can feel like it's working against you. And honestly, for a lot of people, it is. So where does that leave us in 2026? Right back at the savings rate. At 3.5%, people are barely putting anything away. That means the margin is thin or non-existent. And when the margin disappears, one surprise expense can knock you off track for months. Which is why housing, debt, and savings all feed into each other. High rent means less to save. More debt means less margin. Less margin means more credit card use. More credit card use means more interest. And suddenly, you're running in circles. But here's the part I don't want you to miss. These benchmark numbers are not moral judgments. If you're 45 with $50,000 saved, you're ahead of the median. That matters. If you have any emergency fund at all, you're ahead of the 24% with nothing. If you're chipping away at debt even slowly, you're making progress. The system is extracting a lot, no question. Landlords profit when housing eats up too much of your income. Credit card companies profit when you can't pay in full. Employers profit when wages lag behind productivity. That's the machine. But you're not powerless inside it. The thing to focus on is the gap between what comes in and what goes out. That's your margin. That's the lever. That little space is what eventually becomes a cushion. Then, an emergency fund. Then, maybe a down payment. Then, a real exit from paycheck-to-paycheck life. It won't happen overnight. It probably won't even happen fast. But it can happen. And you do not need to measure your life against the most inflated averages on the chart. If you've got savings, you're already ahead of people with nothing. If you're reducing debt, you're moving in the right direction. If you're building even a tiny bit of margin, that's not nothing. That's the beginning. So, if these numbers made you feel behind, don't spiral. Use them. The averages are messy. The system is brutal. But your next move still matters. Start small. Track the gap. Build the margin. And stop comparing yourself to people whose finances were boosted by timing, asset ownership, or luck you didn't get. You're not racing them. You're trying to build stability for yourself. And honestly, that's a very good fight to win.